All right, let's talk about something that gets a lot of investors excited, and maybe a little confused: stock splits. So a company you own stock in announces a split. You log into your account and boom, you've got way more shares than before. It feels amazing, right? But what does it actually mean when Uncle Sam comes knocking? Let's break it all down and get you ready for tax time.
You see that new, bigger share count, and the first thought that pops into your head is probably, wait a second, did my investment just double? It's the dream, right? Who wouldn't think that?
Well, before you start planning your victory lap, there's someone who sees it a little differently. And that, my friends, is the IRS.
So what's the deal here? When it comes to the IRS, their rule on stock splits is actually pretty straightforward. It basically comes in two parts. There's some really good news, and then there's a little catch, a bit of homework you have to do.
Okay, first, the good news. And it's great news. A stock split is not a taxable event. You can just breathe a huge sigh of relief. You don't owe the government a single penny just because your 100 shares suddenly became 200. Why? Well, think about it. The total value of your investment, your slice of the company pie, hasn't changed. The pie's just been cut into more slices.
Now for that catch I mentioned. This is the homework part. While you don't owe taxes right away, the IRS requires you to do something really important. You absolutely must adjust your cost basis for each share. All this means is you need to take the total amount you originally paid and spread it out evenly across all your new shares.
And before we get into the weeds, let's just make sure we're crystal clear on what cost basis means. You're going to hear this term a lot. Just think of it as the price tag on your investment. It's what you originally paid for your stock, and it's the all-important number you'll use down the road to figure out your profit or your loss when you finally sell.
So, how do you actually do this adjustment? Honestly, the math is super simple, especially if you were lucky enough to buy all your shares in one go. Let's walk through it. Let's use an example. It makes it so much easier. Imagine you bought 100 shares at $50 a pop. That's a $5,000 total investment. That's step one. Then, step two, the company does a 2-for-1 split. So now you have 200 shares. So for step three, you just take your original $5,000 and divide it by your new share count of 200. And there you have it. Your new cost basis is $25 per share. See? Simple.
Okay, that was the clean and easy version. But let's be real, most of us are buying shares over time, right? You buy some here, some there, all at different prices. So what happens then? How does that change the math?
Well, when you've bought shares at different times, the secret is to treat each purchase, what we call a lot, as its own separate little calculation. You just do that same simple division we just talked about, but you do it for each block of shares you bought, one by one.
Check out this table. It makes it really clear. Let's say for lot 1, you bought 100 shares for $1,000. After a 2-for-1 split, that lot turns into 200 shares. So your new basis for that lot is $5 a share. Now look at lot 2. You bought another 100 shares, but this time for $1,200. After the split, you again have 200 shares, so your new basis for this specific block is $6 per share. You just keep each one separate.
Okay, so we've done all this math, but why? Why is this so important? This is where we get to the long-term payoff, and trust me, getting this right now will save you from a world of hurt later on.
Getting your cost basis right is a huge deal for a few reasons. First off, your original purchase date carries over to the new shares. That's super important for knowing if your gains will be taxed at the lower long-term rate. But the big one, the most important reason, is that this adjusted basis is the exact number you'll use to calculate your capital gains or losses when you sell. If you use the wrong number, you could end up paying way more in taxes than you actually owe. Nobody wants that.
All right, let's wrap all this up into a clear, simple to-do list for you. This is your action plan to make sure you're totally on top of your game come tax season.
And I can't stress this enough. At the end of the day, it is your responsibility to keep these records accurate. Your broker will send you statements, sure, but the buck stops with you. You've got to be the one to track these adjustments, especially for stocks you've held for a long time.
And when the day finally comes that you decide to sell some of those shares, this is where all your record keeping pays off. You'll take that carefully adjusted cost basis and report it on a couple of IRS forms, specifically Form 8949 and Schedule D. That's how you'll correctly report your gains and make sure you're paying the right amount of tax.
So yeah, your brokerage report is a great place to start. It's a useful tool, but it's not the final word. The real question I want to leave you with is this: are your personal records updated and ready to go? Have you done the homework so you truly prepared for tax season?